In 1 month last year, I made almost $40,000 with my breakout strategy, and I used 5 confluences with this strategy. And this framework of confluences that I used didn't just work once. It skyrocketed my profits month on month ever since. And now, today, I'm going to show you the exact 5 trade confluences which you can just copy and use for yourself with any trading strategy to finally become profitable at trading. So let's hop in and have a look at how it works. So here is my 5 confluences that I use to get really high probability trades, whether you're trading my breakout system that I have shown multiple times on this channel. If you want to have a look at how it works, I will link it in the description below. You can learn it in one of those videos for free. I've shown it multiple different times in multiple different formats. You can learn it there. And then you apply this on top of your existing strategy. Again, whether you're trading breakouts, whether you're trading supply and demand, whether you're trading ICT, you can add these confluences as a filter to give yourself a big boost in win rate. You can go from 60% win rate to 70% win rate once you add these confluences because they are universal. So once your trade setup is deemed valid, you then apply these 5 confluence systems to determine the quality of that particular trade setup when it is presented. Now the first is the 50 SMA, and that is the 50 simple moving average, which you can add to your chart simply by clicking on indicators on TradingView. So there's 2 questions we ask ourselves when we're looking at the 50 SMA as a confluence. And the first is the 50 SMA trending over a significant enough period of time throughout the day? And we'll discuss what a significant period looks like. And then the second question is the 50 SMA pointing in the direction of the trade? So let's have a look at an example of that. So these examples are for a buy trade setup. So what we look at is Tokyo session, which I've outlined here in a box. And what we need to ask ourselves is the SMA trending since Tokyo session. So here you can see Tokyo session. We've been trending upwards clearly since Tokyo session. Okay, you can look even further than that, and we were trending even since before then. So you can see we're clearly in an uptrend here. So that's how I determine whether the 50 SMA is trending or not. So here is the second question we ask ourselves. Is the 50 SMA pointing in the direction of the trade? Here, in the same example, we can see it's been trending upwards since Tokyo session. And then we can see that the 50 SMA is pointing upwards. Okay, we clearly have the 50 SMA pointing upwards, which is really important. So here's another example down here. Price has been trending down since Tokyo session. So here's Tokyo session. We've been trending mostly downward since Tokyo session. However, what you can see though is that the 50 SMA is actually pointing upward, right? Okay, so you can see a price has just started curling up, even though the 50 SMA has been trending bearish since Tokyo. And so what we're seeing here is conflicting information, right? So just because it's pointing upwards, that doesn't actually mean much for me. What is important is that it's been trending downwards since Tokyo session. And so just because it's curled up once does not confirm to me that price is trending downwards. So for me, this would be a bearish market. Okay, I would not be wanting to take buy trades in a market like this, even though price has curled upwards. I would be looking for sell trades only with this particular confluence. Let's have a look at the next confluence, okay, which is one of the most important confluences for me. And that is 4-hour zones as a confluence. Now, you might ask yourself, how do I draw 4-hour zones on the chart? It's simple. It's just simple support and resistance. They don't need to be complicated. You don't need to put a lot of pressure on the system. It's really so that you can see the general trend of the market. And if you get the zone a little bit wrong, which I know most of you won't, because support and resistance is super easy to draw, but I will give you a few pointers in this section. So the 2 questions we ask ourselves with this is price inside of a 4-hour zone? And then we want to ask, is price within X pips of a zone. Basically meaning, is there enough space for us to get involved in a trade before we get to a significant zone where price can then reverse on us? So let's have a look at a diagram of what I'm talking about. So the first thing you want to make sure is that you're not buying or selling into a 4-hour zone, which is really what we're talking about over here. Okay. Then the other thing is price inside of a 4-hour zone? All right. So make sure there is enough room to buy or sell. Meaning, if we're in the middle of zone here and this zone here, so over here somewhere, we can take buy trades and we can take sell trades. Okay. Kind of like what's been annotated right here. So if we're in the middle, we can take buy or sell. But if we're at the top or the bottom, okay, so if we're up here, down here, we can take buy trades only until we break out of this. Okay, so if we're down here, we can then take sell trades. But until then, we can only take buy trades if we're down here, because we do not want to sell into this brick wall. And similarly, we do not buy into this brick wall here. I cannot tell you how much that has saved me personally. And what the rule of thumb is that that's why we have this rule here. Is price within X pips of a zone, meaning X is your stop loss size. Meaning we want to get at least to 1-to-1 risk reward. So if your stop loss is 25 pips and you're taking a buy over here, we want to make sure that there's 25 here, okay, and that there's 25. So if your stop loss is 25, we want to make sure there's 25 here, okay? I hope that makes sense, because we want to get to 1-to-1 at least, so that you can take profit at 1-to-1 or go break even at 1-to-1. That's just personally how my breakout strategy works. And the second thing is you want to make sure you're not buying or selling if you're actually between the 4-hour zones. Meaning, right, if there's price action within here and we have our zone drawn here, okay, because we draw from the top of the wicks to the majority of the bodies, right? We often have this big zone. We do not want to take trades within the zones because it makes trades less highly probable, okay? Now, this is what you want to do, and this is what you don't want to do. So instead, we want to wait for price to break out of the 4-hour zones if we are currently inside. We don't want to be trading inside of these areas. We want to wait for price to break out first, okay? Now, or we wait for price to break back in and we can take trades inside of these 4-hour zones. If price is in the zone and we are too close to the zone, we're going to take positions away from these zones. If we are nearer than your stop loss, okay, amount of pips from these zones. Meaning, if I don't have enough space to buy in here, if my stop loss is 25 pips, okay, so say I buy here, and there's not enough, more than 25 pips. If my stop loss is 25 pips, I need at least 25 pips of room here before I get involved in a trade. Okay, otherwise I'm just looking for sell trades. And this is kind of how I predict, how I determine the bias of my trades. Okay, this is a bit of a more complex one, but all I suggest to you is start drawing up 4-hour zones and look at how price reacts to them on the lower zones. You don't need to be precise with this. It is a rough framework for you to take trades inside so that you can stay safe without having your trades reverse on you. Now, the third rule is one of the most important rules, okay? Is price overextended? Okay? This is going to apply especially to ICT traders, but majority of this rule focuses around breakouts and support and resistance trading like we do. So the first question you ask is, has price reached take profit before tagging us in? That actually applies to supply and demand, support and resistance, ICT. The next rule is price close to TP before tagging us in? Okay, so those are two different rules. So here we can see in this example, price has reached profit target before tagging us into a trade. Okay, so you can see We pushed up all the way here, and we have not yet been tagged into a trade. Okay, whether you're trading versus on support and resistance or supply and demand, it doesn't actually matter. Whether you're trading fair value gaps, this applies. It's huge. So this puts us at risk because price can build momentum when approaching your entry point coming back down, which people call catching a falling knife. So you can see in this example, it comes all the way up and then just falls because we've gone high. Okay, the higher you are, the harder you fall. And that's the same for this. So ideally, what we would have wanted to do is catch the move as it's pushing up with momentum. But what we end up doing is catching the trade as it starts building momentum to the downside. Okay, the trade then gets fully invalidated for me. I don't take the trade. If the price pushes to 150% of the profit target before tagging us into the trade. So here you can see we have our profit target is at 1 to 2 risk reward ratio. 150% of the profit target would make us at 1 to 3. Okay, so if we get to 1 to 3, which would be roughly up here, I would then invalidate the whole setup fully. Okay, so that's what I look for in this example. So here you can see the stop loss is 25 pips and the target, it got to 75 plus pips, which is 150% of the take profit, which means that it's now invalidated for me. This will save you from this scenario. Okay, it will save you from that scenario. That's why this particular confluence is so important. Now, the next thing I look at only applies to those of you who trade the NASDAQ, but it's the S&P 500. Is it correlated with the NASDAQ, okay, at current? Basically meaning, is the trade idea that we're about to take in line with what's happening on the S&P 500? So we ask ourselves 3 questions. Is the S&P 500 approaching a 4-hour key level, okay, which could push price against us on the NASDAQ? And we also ask ourselves, is the S&P reacting to a 4-hour or 5-minute key zone that may push NASDAQ against us? Okay, and then we also want to ask, is the S&P pushing aggressively against our NASDAQ bias in any way, shape, or form? So let's have a look at examples of this. So here we can see S&P is aggressively pushing to the downside, all right, which would mean that if we're trying to take buys in this example, it would be silly to take buys on NASDAQ when the S&P 500 is doing this. Okay, and that's when we sit out of a trade if you're trading NASDAQ. Then here we've got the S&P 500 reacting to a key level on the 4-hour zone on the S&P 500. If we're trying to take buys on NASDAQ, we're going to get completely wrecked because price is going to react here statistically very soon and push downward. Okay? Here we have the S&P 500 reacting to a 5-minute key support. Okay, it's a resistance zone, not a support. That's a typo. But basically, we've got this key zone here where price pushed in aggressively and pushed aggressively out of. Very, very key zone. And it's reacting. We do not want to be taking buys on the NASDAQ when S&P is reacting like this. Okay, but you may be asking yourself at this point, how do I know if I'm waiting for all of these confluences to be in line? I'm going to be waiting forever, right? Well, there is something called the confluence matrix, which I will show you briefly in a second and how I use it. Okay, basically it's a score. It's a way to score your trades and grade your trades based on these 5 confluences. But first, let's have a look at the last confluence. That is the price imbalanced? Okay, this also has to do with price being overextended, but it's a slightly different concept. Basically, an imbalance is what ICT traders refer to as a fair value gap, but it's basically when price moves super quickly in one direction and leaves orders behind, okay? These are orders. And what price likes to do is come back and collect those orders before pushing upwards again. Meaning, if price pushes super aggressively and I get in over here, there's a chance it's going to come back out, take out my stop loss, okay? it takes out the stop loss, and then we get completely screwed. So we want to make sure we don't get involved in situations like that. So the questions we ask ourselves is, will this imbalance make it more likely for stop losses to be hit? Okay. Is the imbalance above the stop loss when we are selling? Is the imbalance below the stop loss when we are buying? Okay. It's very important for us to see the difference between those two. So in this example, there are no gaps under the stop loss. So here's a stop loss. There's no gaps here. Everything has been filled already. And you can see that this trade works out perfectly. We break out here, break and close. We get in here, and then we push up aggressively and take profit. Then in this example, there are 3 gaps in price that are likely to draw price to fill and prematurely stop us out. So you can see we break out here, and down here, we've got a gap here, a gap here, and a gap here. Again, you can see these are aggressive candles that push up, and there is no point at which price has come back down to fill these imbalances here. Okay, if you don't understand what imbalances are, just look it up on YouTube. There's plenty of people that show you exactly how to do it. In fact, I've done it in multiple of my videos as well. So most of you will know, especially if you trade ICT or fair value gaps. All right, so you want to make sure that there are no imbalances below your entry if you're taking a buy setup, and it will be inverted for sell setups. So if we're taking a sell, we want to make sure that there are no imbalances above price. All right, so how do we grade our setups based on this 5 confluence system? And this is where things really come together. So for example, if this confluence is against us, the 50 SMA, and if price is overextended, so it's against us as well, we've then got 3 out of 5. How does that, is that a high probability setup or not? Well, let me show you exactly how I grade them. So an A+ setup, which is 5 out of 5 of the confluences, I usually will go in with full risk, okay? If it's an A setup, meaning we've only got 1 against us, 4 out of 5 of our confluences, I then go full or half risk on this setup. So by full or half, I'm meaning that depending on how my trades have gone before this, so if I've got, quite a few winning trades behind me, I'm going to go full risk. But if I'm in a slight losing streak or I've taken a couple losses, I'm still going to go half risk, okay? If we got a B setup, I'm not going to take the trade at all, or I'm going to go half risk. Now, again, this is dependent on how my trades have been going so far. So if I've taken a few losses, I'm likely going to ease off and not take a trade on a B setup. But if I've had a few wins and I've got some buffer in my account and I'm willing to take the risk, I will take half risk only on the setup. I will not take full risk on a B setup. And then a C setup, I will not trade at all. So how do we grade these setups? Well, it's simple, like I just explained before. An A is 5 out of 5, and an A+ is 5 out of 5, an A is 4 out of 5, a B is 3 out of 5, and a C is 2 out of 5 or less. So you can take a screenshot of this if you like, but basically this is how you can grade your setups. Okay, and again, this isn't the strategy I trade. These are just simply confluences I've added to my strategy to make it way more profitable. Even if you just traded the strategy blindly, you would probably still be really profitable, but this pushes your win rate up insanely. So it's one of the most valuable things that I've added to my trading. So you can see here in this example, in an A+ setup, the 4-hour zones are against us. We aren't overextended. The S&P 500 is in confluence with us. The 50 SMA is in confluence, and we don't have any imbalances. So it's a 4 out of 5, okay? In this example here, the 4 hours are against us, right? We are not overextended. The S&P 500 isn't in our favor, okay? But the 50 SMA is, and there are no imbalances. So we've actually got a 3 out of 5. So we can take that setup if we've had some good trades up till now. But if we're in a bit of a losing streak and we don't have a lot of extra buffer in our account to risk, we're not going to take the trade. Now, there's an extra. Okay, there's an extra confluence that's part of my strategy. If you're trading ICT or supply and demand or any other strategy, you can forget about this. But if you're trading breakouts like me, the liquidity sweep is the bonus. And the bonus basically will turn one of these reds into a green, meaning it can turn a B setup into an A setup or an A setup into an A plus setup. So basically, it will turn one of these red X's into a green tick. So what does that actually mean? So basically a liquidity sweep is when we've got our two zones that we're about to trade our breakout from. And if you want to understand the breakout strategy I trade, I will link that in the description down below. Okay, you can learn it for free. Now, if price attempts at this point to break out and leaves a wick behind, but it does not break and close, it must break and close for my strategy, and pushes aggressively in the opposite direction, that is a liquidity sweep, which makes it super highly probable when it breaks out on the other side. Okay, and if that occurs in my breakout strategy, it then adds an extra point. Those of you who have gone through all of my education already, you will understand exactly how this works. If you want to learn how I trade for free, you can join my free live sessions, which I host every single day before New York market open. The link to join those is in the description below. It's totally free. And I trade live every single day in my inner circle, which is unfortunately only available to my private group. But I record those sessions every day and I post them for free. I've got a whole archive of over a year's worth of trades, and you can access that for free in the description down below. You can see all of my live trading sessions, so you can learn exactly how I trade the strategy, and you can see the results because we're totally transparent. For over a year, we've been profitable trading the strategy, and we've recorded each and every session for over a year. You can also see the documented results there as well. That's all in the link in the description below in my Discord. So I hope to see you there. Thank you for watching, guys, and I'll see you in the next video. Cheers.